Okay, so here we are at chapter 4. Chapter 4 is kind of a milestone chapter in this textbook because it deals with completing the accounting cycle. Um, we looked at in the first chapter some introductory material and terminology with regard to accounting, financial accounting. We looked at all four of the financial statements very briefly. Then we went on to analyzing transactions and making an unadjusted trial balance. Then we spent some time on the adjusting process in chapter 3. Now uh, we need to complete the accounting cycle, which is usually going to be 1 year. For our purposes, it's going to be 1 year. There's some stuff in your chapter about what an accounting cycle is, but I will just tell you that for our purposes, it's going to be considered to be 1 year. Okay, so how do we close from the current year to the next year? In other words, if we have $100,000 in revenue for this year, how do we kind of make that break off point at the end of the year and then start over at the beginning of the next year? And that's really what most of this chapter is about. So we've got some objectives here. We are going to, when it says prepare financial statements from the adjusted account balances, this sounds really, really rough. It's not. But we are going to look at how to make the appropriate journal entries so that we can close out from 1 year to the next. We're going to look at all of the steps in the accounting cycle again, and then objective 5 says illustrate the accounting cycle for 1 period. All right, so let's talk a little bit about the income statement. Bet you didn't know this. We talked about in the previous chapters, we said that the income statement is the first financial statement prepared. But look what it says here. It says the income statement is prepared directly from the adjusted trial balance, beginning with fees earned / revenue. So if you recall, I've told you before that the chart of accounts and the trial balance, the accounts within both of those are listed in the exact same order. We start off with current assets, specifically cash and cash equivalents, and then we move down into non-current assets, then we move into liabilities, both current and non-current, then stockholders' equity accounts, then revenues, and then expenses. So if we were looking at an adjusted trial balance, we would need to skip down to the revenue accounts. I actually break the trial balance down into 5 parts. And it could be broken down into more than that, but in my mind it's 5 parts. It's assets, liabilities, stockholders' equity, revenues, and expenses. So I know if I'm starting with revenues, I'm going to have to get a ways down into the trial balance before I can pick these numbers up. So if I were to do that, I would look at the adjusted trial balance for, who is this? Net Solutions, the company we've been looking at. And I would find that fees earned are $16,840, and that we also had that rent revenue that we earned of $120. So we would have total revenues of $16,960, and then I would just simply go and I would just pick up each one of these expenses right off the trial balance, and I would plot it here as a debit. See, it's how this column here is over to the left, but our total of revenues is over here to the right. That's not just because we were being sloppy. That's to indicate that revenues have a credit balance. See how everything kind of ties together? We have total expenses. We move that over here so that we can subtract it from the revenues, and we come up with net income. Okay, 7205. So again, the point of the income statement is to determine net income or net loss for a period of time. This particular one says for 2 months ended December 31st, 2005. That's because Net Solutions opened on November the 1st. We could have just as easily said for the period ended December 31st and left it at that. Here we have a retained earnings statement, and it says here at the bottom, it says the retained earnings statement is prepared second using net income from the income statement highlighted above. So again, now this is a different company, and what's going on here? I just noticed something. Darn it. We have a problem here. This 7 is wrong. So while we were on this slide, let's just change that to an 8. That should say for the year ended 2018 or December 31st. So we have our beginning retained earnings, which was last year's ending retained earnings of $50,000. Okay. Then we add to that net income for the year. And this is why the income statement must be done first, because we need this number. In this case, it was $20,000 for this company, ABC. Then we're going to subtract out all the dividends that we paid, and we have ending retained earnings of $30,000. So for our purposes at this point in the class, I want you to think about the stockholders' equity section of the balance sheet just for a moment. Okay? And I want you to understand that there are 3 parts. We have, well, there are three primary components. There's common stock and retained earnings. So there's 2 parts that are going to show up on the balance sheet. Okay? Dividends is a stockholders' equity account. But do you see what we've done here? We had our beginning retained earnings, our net income flowed to the statement of retained earnings, so that we're at $70,000, but then we subtracted out the dividends of $40,000. So when we look at our balance sheet, and for this company we would see common stock of whatever amount it is, and then we would see retained earnings of $30,000, please do understand that our dividends have been accounted for, even though we don't actually necessarily see them on the balance sheet, on the face of the balance sheet, okay? All right, so let's move on then to the balance sheet, and it says the balance sheet is prepared directly from the adjusted trial balance, beginning with cash. And the great thing about that is we don't even have to skip down to find the revenues. We can just start right at the very, very top of the balance sheet. And it says here, it says the asset and liability amounts are used. Okay, the retained earnings amount is taken from the retained earnings statement. So that's going to change. And that, that's automatically populated. We're not really doing these statements by hand. So we're not legitimately, or we're not actually looking back at the retained earnings statement and saying, oh, it was $30,000. Okay, let me write that in on the balance sheet. That's not how it works. This is all automated. But I do want you to understand kind of what the computer software is doing behind the scenes, okay? So we have to wait and do the balance sheet third because we need the retained earnings amount from the retained earnings statement, okay? So here we have an adjusted trial balance for a completely different company. But if you look at this, you will see that we start off up here with current assets, cash. We've got about 4 of them. Then we have a long-term asset called leasehold improvements. Then we have our contra asset account, accumulated depreciation, which has a normal credit balance here. So what this tells us, just so you know, is we have a net book value, if you would, of $98,000 on these leasehold improvements. So see, well, I want you to just see something real quick. Accumulated depreciation, $2,000. Look down here, depreciation expense is also $2,000. We talked about that at the end of chapter 3. And then we go into our liability accounts, accounts payable, accrued expenses, unearned income. These are all current liabilities. And we have our long-term liabilities of $99,500. This is probably some kind of a long-term bank note. They borrowed $100,000 for these leasehold improvements, and then they've made a few payments, so their current balance is $99,500. Then we go into I made these lines here to show kind of the stockholders' equity section. So I want you to please do understand that common stock is always going to show up on the adjusted trial balance, and dividends will. So again, dividends will absolutely show up on the adjusted trial balance. It just won't show up on the balance sheet. Then we move in, we have our revenues here. For this company is 27.8. We do have a new expense account called cost of goods sold. Now, we're in the next chapter, we're going to talk about retailing businesses, and we're going to introduce this account more formally. But do know that it is a legitimate expense account. And in fact, cost of goods sold for a retailer is usually the largest expense. And then we have, after that, we have all of these other kind of normal operating expenses that we've already discussed in previous chapters. And as usual, our credits and debits match. This does not mean that all of these figures up here are correct. Okay, that's not what it means. But we will balance, and assuming that all of these numbers are legitimate and they conform to our expectations of what should be there, especially since we've only been open for a couple of months, then we're probably good. All right, so I need to introduce to you a concept related to the closing process. We need to discuss what are called permanent, or sometimes referred to as real accounts. Accounts that are relatively permanent from year to year are called permanent accounts or real accounts. Now, pay very close attention here. A couple things I want to say. Number one, if there are permanent accounts, you better believe there are non-permanent or temporary accounts. The other thing that I kind of want to just clarify real quickly here is that all of the accounts are permanent. What we're saying here is that certain amounts on the balance sheet roll forward from year to year. Okay, the balance in cash on December 31st then becomes the beginning balance January 1st. Okay, but all accounts are going to be on our trial balance. All right, but the permanent accounts, these numbers will go from the current year to the next year. All right. Notice it says this includes accounts reported on the balance sheet, and it could also say very easily only, meaning only balance sheet accounts are permanent accounts. Only balance sheet accounts are permanent accounts. So that leaves us, or that brings us to temporary accounts. Accounts that report amounts for only one period are called temporary or nominal accounts. Temporary accounts, at least the amounts for those temporary accounts, are not carried forward from year to year because they relate to only one period. This includes all accounts reported on the income statement as well as the dividends account. And the reason that dividends are included is because if you think back to the retained earnings statement, those dividends that are paid out, we're talking about just the dividends for that year. Okay, just the dividends for that year. And I want to, take you down memory lane a little bit here. If you recall, one of the very, very first things we said when we were talking about the income statement, we said that the income statement shows net income or net loss for a period of time. For a period of time. For example, January 1 through December 31. In the case of our Net Solutions example, November 1 through December 31, right? And then we said that the balance sheet was a point in time, a snapshot. So there's some permanency there if you think about it. Doesn't matter, you know, if you buy, think about it, if you buy a building for $100,000 in March of 2017, well, you're probably still going to have that building, you know, even 10 years later in 2027, and it is an asset. So therefore, the amount allocated to that asset, $100,000, needs to show up on the balance sheet. So that's it. That would be a permanent account. But temporary accounts, again, all of the income statement accounts as well as the dividends account. Okay. All right, where are we at here? I think what we're going to do is we're going to go ahead and end this video right here, and then we'll pick up with another one, finish up the chapter.